Netflix stock is down 70%, from $600 to $200. Is it worth the current $200? The following is only my opinion and is not a financial advice. So Netflix company has seen a real high growth over the years of tens of percents, and its current revenue is about $30 billion a year. However, after removing all the expenses, we are getting to about $5 billion of income of clean revenue, and then they take this revenue and invest in creating new series and new original series and movies. So they take all the profit of the $5 billion and reinvest it in creating new Netflix originals. Recently, new players have came into the game, which makes the prediction of whether the company or the stock at the $200 price is good or not. They have lost some subscribers, but this is, I think, not the worrying part. The worrying part is the coming up competition from additional companies. The question is whether they can continue ruling the game. And as it looks, it doesn't look like anyone is able to answer this, because this is something of the future. We are not able to answer this. As we are not really able to answer this, we are not able to tell whether the $200 price, which is 1/3 of the max of the $600 price, is worth it. The good point about Netflix is that they were able to reinvent themselves in the past when they faced any difficulties. So this shows that this company has some resiliency to new things happening, such as this competition. They said that they would start like a new line of business of ads. So this means that you could probably not pay a monthly subscription or a really reduced monthly subscription and then see some ads. I personally prefer the subscription. I prefer that people pay for the subscription rather than ads, but let's see how it's going. But this show again the resiliency of this company by being able to reinvent themselves, and when subscribers are going off, then they are reinventing with advertisements and free subscription. So the current PE, the price earning ratio of Netflix, is around 18.06, 18 years to return on investment, which is a little bit on the good side. However, I'm not sure if this already means that it's a good deal. It's not yet that of a good deal. If we compare this to Facebook's PE ratio, which is currently 14, this looks, at least on this measurement, a better deal. Facebook is basically back 4 years back on its stock price to 2018. Netflix is even back further on. It's back to 2017 price. So basically, Netflix margins are good. They are reinvesting. They know to reinvent themselves. However, I think everything can happen, of course, in the future, right? It's a speculative, maybe, but is it a sure bet? For sure, no. It looks like a bet. It could go up depending on the economy, depending on the interest rate, but based solely on the raw data that we see, the competition that is coming, we do not really know what would be a good price for Netflix if it goes further down. If it crashes on another 50%, then maybe this becomes something which is more interesting. In this kind of crashes, we need to look for companies who did not crash to normal values, because this appears to me like a current normal value, maybe a little on the lower side, but we should look for things that crashed much more, at least on the speculative bet side, right? Because if we're looking at something that is a little on the lower side, then let's take a better stance on it. Let's go for the whole index. Why go for a specific company if we are not sure what the future will bring. If it's a really good bet, then we want the price to be really cut. Otherwise, I think, at least in my mind, as I said, this is my opinion, we prefer the index as a safer bet.